All right, hello everyone, and welcome back. All right, so now what are we going to do? We're going to take a look at the fundamental analyst approach. Of course, there's two main schools of thought about making investment decisions when it comes to trading and timing those entries and exits. Of course, we have the fundamental approach and the technical approach. Tomorrow, we're going to be dealing with the technical approach. Today, we're going to go through an introduction to the major macroeconomics, essentially, that affect currency prices. So, an introduction into one way to view an economy. So, fundamental analyst approach. So, we start off with economic forecasting. Fundamental analysis can be defined as a study of a country's economic and financial performance in order to determine the fair market value and future direction of its currency. Now, fundamentals focus on factors that determine the exchange rates, such as country's economic health, political stability, even environmental events. A popular way to get an idea of the health of a country's economy is to look at its economic indicators and data releases, which is why every trader should be familiar with them and how they influence the value of a currency. Now, fundamental analysis with pairs such as Euro-USD focus on how well each economy is doing contrast to the other. So, for example, in the case of the Euro-USD, if the European economy is doing better than the American, we would expect the price of the Euro-USD to go up. On the other hand, if the American economy is doing better, we would expect the US dollar to strengthen against the euro, meaning that the Euro-USD price to go down. Yes, if the Euro-USD as a pair goes down, what does that mean? It means that the euro is depreciating and the US dollar is appreciating. Yes, now our target is to evaluate how well the economies in questions are doing and find which currency will appreciate and which will depreciate. Now, what are the major macroeconomic indicators that can give hints to the future direction of the market? Interest rates, inflation, gross domestic product, unemployment, and trade balance. So let's take a look at each of these individually. Interest rates, starting from interest rates, are perhaps the single most important indicator when it comes to determining a currency's long-term value. So in the long term, interest rates have the biggest effect between two currencies. Now, central banks usually announce interest rates every month, with the whole forex market watching closely to see what they will do. By adjusting interest rates, a central bank can control the supply of its currency, directly affecting its value. Now, one of the key factors that influence a central bank's interest rate decisions are growth levels and inflation. But before we get to those, to see how the central bank may take action for the interest rates, let us better understand how interest rates affect. So if interest rates are increased, what does this mean? It means it becomes more expensive to borrow money and it becomes more attractive to save. Yes, more attractive to save because we're earning a higher interest rate for the money we deposit. More expensive to borrow because we're paying a higher interest rate for the money we are borrowing. Now, these two effects together cause the amount of money in circulation to shrink as people have more incentive to saving money, less incentive to take out loans now that loans are more expensive. So interest rate increase shrinks the amount of money supply in circulation. On the other hand, decrease in interest rate, what effect does this have? Well, borrowing from banks becomes cheaper since there's a lower interest rate now. Many corporations, many companies may take this as an opportunity to take out loans and invest in their businesses now that the interest rate, the rate that we're paying for that borrowed money is less. Yes, so lower interest rate, more incentive to companies to take out loans and invest in their business. So borrowing goes up, saving becomes less attractive. We're earning less money for are saved deposits in the bank, lower interest rates. So less incentive to save, more incentive to borrow and invest, causing the supply of money in free circulation to increase. Now, higher interest rates tend to increase demand and value for the currency, while lower rates decrease demand and lead to a weaker currency. Traders use announcement and economic indicators to understand a central bank intentions to changing rates. Markets may move in advance of anticipated rate changes and also as a reaction to actual announcements. So, interest rate, very important for the long term. Now, as we said, what are two factors that may affect the central bank's intentions about what to do with the actual interest rate? It is the growth levels and inflation. So if we take a look at those, inflation rate, what is inflation? Inflation refers to the persistent increase in price levels over time for the same quality product. Common measures of inflation include the consumer price index, known as the CPI, and the producer price index, known as the PPI. And they're usually released on a monthly basis. Now, central banks usually have a target inflation rate of where they want to be. If inflation is above expectations, the currency will likely to strengthen, while lower than expected inflation likely to weaken the currency. Low interest rates and rising growth tend to push prices higher and put more pressure on inflation. And when inflation starts getting too fast, when inflation starts to go above expectations of the central bank, then this calls for a possible hike in interest rates. So in other words, as more inflationary pressure is added, it also adds more pressure to the central bank to raise the interest rate sooner rather than later. Yes. So if inflation is running high above expectations, more pressure on central banks to increase those interest rates and shrink the supply of money in circulation to put that inflation under control. All right, high inflation, of course, erodes the value of a currency and is therefore considered bad for any economy in most circumstances. Central banks normally target an inflation level between 2 to 3%, and if their target is exceeded, they usually take action to bring it back down to the desired levels. Now, one of those actions is, of course, the interest rate. On the other hand, when inflation is high, the market begins to expect that the central banks may increase interest rates, which directly affects the strength of the currency. Now, the expectation of an interest rate hike alone, the expectation that the central bank has intentions to raise the rates, this expectation alone will cause the currency to strengthen as the market tries to price in the anticipated change in an effort to benefit from any announcement before it is officially made. All right. Now, the next aspect that can affect the central bank's intentions about interest rate are, of course, the growth, the gross domestic product, in other words, the growth levels. So a country's gross domestic product is the value of all goods and services produced within a country in a given period of time. It represents the health of a country's economy, the GDP. Now, changes in GDP levels are used as a measure of economic growth and therefore, and usually expressed as a comparison from the previous quarter or previous year. Rising GDP levels point towards a booming economy, stronger currency, but are also accompanied by higher inflationary pressure. Declining GDP levels signal towards a recession period and a weaker currency. Now, GDP is a major news release and is used to reflect the strength and weakness of economies along with the interest rate expectations. And another macroeconomic aspect is, of course, the unemployment rate. Unemployment is an important measure of the health of a country's economy and pace of its economic growth. Increasing unemployment has a negative effect on a country's economic growth, while, of course, decreasing unemployment is seen as a positive sign for the economy. Rising unemployment signals a troubled economy. The market may expect the central banks to reduce interest rates in order to increase the supply of money and help boost economic activity and growth. Now, higher than expected unemployment normally causes the currency to weaken, while lower than expected unemployment usually results in a stronger currency. Now, as well as unemployment and employment figures, other common labor-related indicators such as the US non-farm payrolls, private payrolls, and claimant count usually come out on a monthly basis. All these have to do with employment statistics. Now, by far the most high profile of them is the US NFP, as it tends to have the greatest effect on the Forex market. So US non-farm payrolls represents the change in the number of employed people during the previous month, excluding the farming industry, and is released shortly after the month ends on the first Friday of the following month. So US non-farm payrolls has to do with the labor numbers, yes, number of employed people during the previous month, excluding the farming industry. So it's connected to the unemployment, yes. Now, US non-farm payrolls has a big effect on the Forex market. As stated, it comes out on the first Friday of every month. So it's what we saw last Friday, yes. This Friday that just passed was the NFP for the November data. Yes, it was the first Friday of December. So every first Friday of the month, the announcement for the NFP of the previous month comes out. Now, it's seen as a high-profile event in Forex because it can cause a lot of volatility. So NFP announcements usually accompanied by high volatility levels, implying the market can make large distances in a small space of time. Right, and the other macroeconomic indicator is trade balance. So trade balance represents the difference between the value of goods and services that a country exports and the value that it imports them at. A surplus occurs if the value of exports is greater than the value of imports, and a deficit occurs if the value of imports is greater than the value of exports. Now, of course, it's in a country's interest to export more than it imports and thereby generate funds that it can use to further its growth. Now, this figure is usually released on a monthly basis. A greater than expected figure tends to be good for the currency, while lower data release tends to be bad for the currency. All right, everything we've seen so far is about well, starting from the idea of what each of these aspects are, how they can affect the market cycle. However, each of these macroeconomic concepts also has the data releases or announcements that go with it. So economic indicators, how to benefit? Well, economic indicators can help you consider trades in the context of economic events and understand price action during these events. Now, you don't need to have an advanced knowledge of economics to make use of an economic calendar, as not every single release must be analyzed in depth. Now, by following GDP indicators, for instance, or inflation, unemployment, you can anticipate market volatility and identify potential trading opportunities. Remember, when high-profile events are coming out, they can often act as catalysts to a certain price move. So also high-profile events is usually when extra volatility comes into the market. So whether we are going to let our decisions be affected by the announcement or not, it is still a good idea to be aware of what and when is being announced, as these announcements can coincide either with turning points or moving in the direction of the trend or turnaround points. Yes, but this is also when we expect volatility to come into the market and when some of the big moves are expected to develop. So whether we are taking into consideration the announcements for our decision-making process or not, good to be aware of when that volatility is going to be coming to the currency pairs that we are trading. Now, how to benefit? You should always know which economic indicator has a greater impact in terms of trading at the moment. And here we're going to put them into three main categories. We have the leading indicators, which change before the economy starts following a new trend. In other words, they predict economic changes, such as the stock market, manufacturers' new orders, consumer goods, business confidence, and building permits. All these things will change before the economy has started following a new path. On the other hand, we have lagging indicators, which, as the name suggests, they change after the economy is already starting to follow a new trend. In other words, they confirm economic changes, such as unemployment, GDP. And then we have coincidence indicators, which tend to coincide with changes in economic trends, such as NFP, industrial production, manufacturing, and trade sales. And news moves the market. Monitoring the economic calendar can help keep up to date with what the major announcements of the week are. Now, depending on the current state of the economy and the financial environment we find ourselves in, the relative importance of these releases may change from month to month. For example, unemployment this month may be more important than trade or interest rate decision, even though interest rate decision is seen as an important long-term indicator. Maybe the market is not focusing around the interest rate decision this month because there's no expectation of anything changing. So it depends. It's important to keep on top of what the market is focusing on at the moment. So this is where taking a look at that economic calendar on the XM website can help be up to date with all this information. So if we go to research and education here on the website, we go back to economic calendar there. All right, so here's our economic calendar. Now, what you can do to filter out a lot of that news is to just come down here to the filter, put the 3 bulls on, in other words, to show us only the most important and high-profile news of the market. And there you see for all this week, what are the news announcements that are going to be there. So depending on the currency pair that we're trading, we want to identify which is the day and the time where there may be a major announcement. And as you see in this week, it's news-filled this week, yes? You see that tomorrow, 11:30 server time, GDP for the 3rd quarter coming out for the Japanese economy, GDP for the 3rd quarter coming out for the British economy. And if we go through the week later on, you're going to see some of those PPI we discussed for the US dollar, CPI inflation, the US dollar, and if we go further down through the week, you're going to see ECB margin lending facility, ECB interest rate decision, ECB press conference. ECB, of course, is the European Central Bank, yes, which controls the interest rates of the whole Eurozone for anyone who is using the euro as a currency. There we have that Tankan on Friday for the Japanese economy, retail sales, interest rate for some other currencies, and then Saturday, when markets are closed, European Central Bank President Draghi speaks. So all these are the high-profile events that we're expecting on this week. So as we see, some important sterling news, some important Japanese yen news, some important euro news. Yes? So this is something good to look at every Sunday night in order to try to plan out the week of what are the announcements we're expecting to come out this week. So now let's see some of those announcements that are connected with some of those macroeconomic indicators we saw. So GDP, of course, it's its own announcement, as we saw tomorrow, coming out for the Japanese yen for the 3rd quarter. Is that correct? Japanese yen for the 3rd quarter and for the sterling pound, 3rd quarter. So GDP announcement tomorrow. So indicates economic growth, often correlated with living standards. Then we have non-farm payroll employment, yes, which is that US NFP that we saw. Monthly report released by the US Department of Labor provides statistical data about the current state of the US labor market. Unemployment rate, the percentage of unemployed people measured by the ratio of people who are out of work and are willing to be able to work as opposed to the number of people in the workforce. Gives you a hint about future interest rate and monetary policies. And CPI, statistical estimate that measures changes in the price of services and consumer goods. CPI is used as a measure of inflation, reports price changes in over 200 categories. We have CCI, Consumer Confidence Index, again, connected, measures consumer confidence. Drastic decreases in consumer confidence may be a sign of a weakening economy. Seen as also an important indicator. PMI, Purchasing Managers Index, indicates economic activity, shows the percentage of company business employees in charge of goods and services acquisitions in a particular economic sector. And retail sales, monthly report that measures consumer expenditure, as a timely indicator of broad consumer spending patterns, can also be used to assess the immediate direction of an economy. And durable goods orders, which has to do with the international trade balance, measures the difference between imports and exports of all goods and services. NAPAM Index measures economy in general and the manufacturing sector in particular, sums up the survey of over 250 companies in all US states, and calculates data on production, new orders, and employment. And PPI, again connected to inflation, Producer Price Index, frequently used economic indicator to measure the average changes in selling prices received by domestic producers in manufacturing, mining, electric, utility, and agriculture. And the Tankan, that is the other announcement that we saw coming out this week of the Japanese economy. It's a quarterly business poll issued by the Bank of Japan on the status of the Japanese economy. Now, it affects the currency rate and stocks significantly, therefore it's considered a major financial indication in Japan. So, news trading, how does it work? Well, the proverb that no news is good news doesn't apply to the Forex market. News makes the market move, and it can make it move very fast. This is why traders want to be aware not only of the releases, but try to guess what the release is going to be before it comes out, because it can bring a lot of volatility to the market and bring sharp moves. Now, news trading means you trade a foreign currency right before or right after an important economic news announcement has been placed. Let me just differentiate here between what we're going to speak about a little bit here, trading the news, and fundamental analysis. Now, fundamental analysis, of course, has to do with the news. It's about gathering information from these releases to understand where in the economic cycle we are. But fundamental analysis is also using all that information to come up with a longer-term view of the market. News trading, while it does have some connection to that fundamental approach, is a more short-term trading strategy approach. Yes, so news trading would be trading before or after a release to profit from that move that is going to happen as soon as the announcement comes out. Now, after such announcements, you can expect prices to fluctuate, to either move up or down. But trading the news through currencies can be very exciting. Why is it very exciting? Because it's also very risky due to the volatility that can be triggered during these news announcements, especially when a news announcement comes out as a surprise. So not what it was expected to be. That is when we're going to get the biggest, the most volatile moves happening in the market covering a very large different distance in a small space of time. So news trading can be done either proactively or reactively. News releases provide fresh information about how the economy is doing. And most importantly, if the data surprise is large enough, the market reaction can last from a few minutes, hours, or sometimes even days. But the important thing here is usually when do the biggest moves happen? When there's a big surprise in the data release. Yes, not if the number is a bit better than expected or a bit worse than expected, but when that number is completely different to what was expected, to what has been priced into the market, that is when you may get the biggest volatility after that news announcement. Now, economic releases can be traded either proactively or reactively. Trading proactively involves taking an educated guess on whether the piece of data will surprise to the upside or to the downside, and placing a trade before the announcement is made. So it involves taking an educated guess about what this announcement is going to be, what is going to happen after the news, taking the position before the news, and praying. Yes, taking the position before the news and praying that you got it right. On the other hand, there's trading reactively, which involves placing a trade after the economic data is released. Now, this may remove the need to guess the economic data, but will also remove any immediate move after the data is released, which may be the big move of the market. Yes. So on the one hand, we have trading proactively, which involves you take the trade from before, which means you take on the risk of whatever may happen during the announcement. Yes, but also you're part of the initial move of the market. On the other hand, reactively involves waiting for the number to come out and seeing if a direction has been established. So trading reactively is about waiting for a direction to be established and then jumping in the market after that news has been announced, to go with the effect, with the reaction of the market after that news. Yes, especially if one direction has been created and that news has pushed the market more in that direction, that is about jumping into that direction and moving with the wave of the market after that news announced. All right. So that is an introduction to our fundamental analyst approach. Yes, and looking at those major macroeconomic indicators that affect the long-term direction of currency rates. Yes, but also speaking about that news announcement, how the market can react around news announcements. Yes, if we take a look at what happened on Friday with the NFP, for example, if I put here my vertical line on the candle of the NFP, that was the candle of the NFP announcement. Yes, so we're seeing a nice big range on that candle on the Euro USD. So we're seeing there, if we go down even to the lower time frames, we'll see how much the market moved in that very short space of time. So there it is. If we look at it, if we look at the specific 15-minute candle where the news was announced at the beginning of this candle. Yes. So just before the news was announced, we see the price was at 113.66. Yes. Let's go back, look at it on the 5 minutes. So it was 113.66 just before that news was announced. And I'll even go down to the 1 minute time frame to see actually how fast the market moved in that range. But just to give you a little bit of experience about what can happen within 1 minute of announcement, if we see there during the first minute after the announcement, market was 113.66 just before the announcement. 1 minute after the announcement, it made it all the way to 114 and it closed at 113.96. Yes, so we're seeing there a 40 pip move in the 1 minute after the announcement. That's the kind of volatility that can come to the market during these kind of announcements. And even this NFP that we had on Friday, I would not call it a very volatile one. So this is one of the smallest moves that can happen during a day like that. Yes, the market can become a lot more volatile than that. Well, we could always see what happened on the 5th of November during the last NFP. So if we go back to the 5th of November and see what happened on that day. So 5th of November, well, that was the NFP candle last time, if that's correct. 5th of November, actually no, 5th of November, sorry, we got the wrong date. 5th was a Monday. First Friday of November was 2nd of November. So the NFP candle was on the 2nd of November at 3:30 time. So, well, also not very volatile one there. That candle there was the candle of the last NFP. Now, of course, in my days, I've seen many NFPs, and I would say that NFP can get a lot more volatile than that. Yes. So what we've seen in these two past NFPs, I wouldn't say is from the most volatile ones. I would say from all the NFPs I've seen, these are quite the lowest volatility ones I've seen. All right. Now, again, it doesn't only matter if the number is good for one economy or good for the other economy, because, again, remember that anticipated things get priced into the market. Yes. So let's say, for example, everyone is expecting a very good number for the euro. Yes, which would mean the euro strengthens. And we still get a good number for the euro, but not as good as people expected. Even though the announcement came up with a good number for the euro could still go down afterwards if the number is not as good as the one anticipated. Yes. So what I'm saying is that often it's got to do with a surprise to what is expected, at least about that volatility in the market. Yes. So the most volatility comes in when the number that comes out is not necessarily what was expected in the marketplace. That's when we get the biggest kind of surprises. But again, if you want to build a little bit more experience on how news can affect the market, then this week is a week filled with news. Yes. So all those GDP tomorrow in the early hours of the morning for the Japanese yen, then the GDP sterling pound. Then the other big announcements of the week, I would say, are, well, maybe this core CPI, but don't expect too much from it. So the next big ones are, well, Swiss franc interest rate decision, euro interest rate decision, ECB press conference, and ECB President Draghi speaks on the Saturday. So you could look at and see how the market reacts at the time of these events to build a little bit more experience about what can happen during these events. Yes. So also I saw some rumors of that Brexit vote being postponed. Haven't found out if it's been confirmed yet or not. Yes. So a lot of things going on with Brexit, a lot of uncertainty there. And if we look at Brexit USD, we've been talking about this strong downtrend for a while now. Yes. All right, everyone. So let's see if there's any related questions to what we may have seen today or some of the things we may have seen during the earlier session. Of course, today was that look at the fundamental analyst approach. What we're going to be doing tomorrow is focusing more on an introduction to technical analysis. So what we're going to be doing tomorrow is an introduction to the technical analyst approach first, to sort of get into the mentality of what we're trying to do as technical analysts. And then in the second session, we're going to start developing our first understanding of technical analysts by chart construction. So first session, to get into the idea, into the mentality, and to understand what technical analysis is all about. And then in the second session, start learning the first concepts of technical analysis. We're going to speak about price charts. We're also going to speak about bar reversal formations and candlestick reversal formations, which can be short-term triggers to signal a change in the short-term direction of the market. How NFP is predicted up or down? Well, it depends also on how much an effect NFP can have on the market in the current climate, yes? How do you combine fundamental and technical analysis? All right, this one's easy. This is how we have it in our trading room. When fundamental analysis and technical analysis do not agree between them, we use technical analysis. When fundamental analysis and technical analysis do agree between them, we still use technical analysis. However, when of course they agree between them, it may give us more confidence of that decision, yes, which may mean a bigger position size, for example. So when both of the approaches are agreeing, it gives more probabilities towards that possible scenario, which could make it more probable, which could excuse a bigger position in that kind of sense. Yes, but as you see, it's the technicals that are driving us. And that's one way of how we combine fundamentals with technicals, yes. Do the tweets of Trump affect the Forex market? It depends what he's tweeting about, maybe in the short term, but in the long term, it's more about his intentions and what he's planning to do and what kind of action is being unraveled until he does that, yes? Can you really take advantage of 1 minute after the news? Well, if you enter the market before the news, you can be part of the market during that first minute of the news. So the way to be part of the market during that first minute of the news is to enter before the news. Yes? In other words, be in the position before the announcement comes up proactively. Yes? Now, if we're not inside the market and we're trying to get into the market in that 1 minute of the news, then no. The market moves at the speed of light in those few seconds when the news comes out. Yes? So, of course, during that time, during that 1 minute, if we have an order in those levels, it might not get executed, it might get executed, it might get executed late. Market moves very, very fast in a few seconds. Yes? So if we want to be part of the market during that 1 minute of the news, we're going to have to get in before the news comes out. Someone is asking tomorrow, Brexit EU vote, is it considered as news? Of course, it's considered news because it is affecting the sterling USD, for example. Yes? So has anyone gotten any confirmation? Is that going through in the end, or has it been postponed or not? Well, I'm going to guess it's been postponed, seeing that the sterling USD has toppled over, breaking new lows and heading to a new low. So this is how I see the news. Let me see the charts and I will tell you the news. Yes? Let me see the charts and I will tell you the news. Now, if the news isn't agreeing with my charts, it's only a matter of time before the news also aligns in the direction of the charts. Yes? Because the charts move faster than the news. So no one can confirm with me if it's been postponed or not. I'm going to have to talk about it later on tonight. So I might have to do my homework. Someone else is saying, can I start actively trading at the end of the 2-week lessons? You can. You can. You can start building experience and go from theory to practice. So first you have to learn the theory. Then you have to go and apply practice and start to learn that theory to the next level, where we go from theory to practice and build experience on all those theoretical cases. All right, so I'm guessing a lot of you today, it's probably the first day you're joining with us. So yes, it's a very good day to start today, because it's the first day of this 2-week course, yes? So now we're coming to the end of the first day. So another 9 days like this one. Of course, the things we're going to be looking at are, we're going to be moving forward in things, yes? So today is the more basic things. So someone was saying, so sterling BBP is going down, bottom seeking. I don't know about bottom seeking. I know that right now it's going down. Yes? So, all right. So a lot of you might want to join into tomorrow's technical analyst introduction to understand what I refer to about as the mentality of technical trading, which is not one surrounded by prediction necessarily. Yes. So what we're doing in the market necessarily is not trying to predict, but more following. Yes. So I want to see evidence of something before I talk about its possibility, in other words. So it's not about what we think might happen in the short-term future. It is about what is happening right now, which doesn't involve what we think about it. Yes. I mean, again, what we talk about tomorrow is that before becoming a trader, first it's about becoming an analyst and understanding how the market behaves, understanding how to balance those probabilities, and start looking at the market from a perspective of an analyst. What has happened? Where are we heading to? Yes. After that, then can speak more about entries or exits and strategies, and more referring to trading. Someone else is saying, is it true that Mondays are not good to trade? And when is the best time to do a week analysis? Well, week analysis would be on the Sunday when the markets are closed and the markets are not moving, and you have time on a Sunday to go through a market review. So a good time to do the analysis of the whole week would be Sunday. And then, of course, every morning on the trading day. But the one we're going to do for the whole week on a Sunday. Now, is it true that Mondays are good or not good to trade? Some Mondays are good. Some Mondays are not so good. Yes. I haven't seen any strong evidence to suggest that Mondays are generally not a good day to trade. Yes, sometimes they might be a little bit slower, but no evidence to suggest one way or the other. And for anyone who shorted sterling USD, they don't have many complaints about this Monday of the market. Yes. Depending on the fast volatility of the market, can you take positive advantage of these up and down moves? What do we mean? Well, yes, that's where a trading system comes into place for which moves to target and when to get in and when to get out. But I mean, as we're going to be discussing over the next coming days, we're going to discuss the concept of a trend and following that trend, and about the life expectancy of that trend or other things. But what do we mean by can we take positive advantage of these up and down moves? Of course, that's what trading is about. But it's also about choosing which of the moves we want to be part of and for what reasons we want to be part of them. And that's where the trading methodology, trading system comes into place. Why do I think that despite of the cut in oil production, the WTI is still going down? Well, is it still going down? I would argue it's not going down. It has stopped going down. So despite they have cut the production, what they have achieved with cutting the production is to slow down the decline. Yes. So we've seen how fast the decline has been in the latest phase of the market. If we come here to the 4-hour, what do we see? We see a range in the market building. So maybe what they have achieved is to slow down the decline, or maybe even to stop it moving down. Now, whether there's going to be a significant bounce or not, we're going to have to wait and see for that. Yes, but they have achieved the slowdown in that we're not moving down anymore at this moment in time. Yes. So we have been moving down. At this moment in time, we are taking a sideways break. Nice analysis. Yes. Do you like that? If I say that tonight in my TV interview, is everyone going to like it or not? All right. All right. Well, I'm going to be discussing U.S. equities tonight at a later meeting. Maybe I should also add oil into that equation since everyone is talking about oil lately. All right, everyone. So any final last questions? All right, everyone. So glad everyone enjoyed that. So how many of you is it the first day that you're with us in these kind of sessions? How many of you is it the first day that you're part of these kind of sessions? Someone asked, is sterling going down? Well, looking at the price, since the price is going down, I'm going to take a guess and say the fundamentals are also going down. Yes? But what's going on right now with the Brexit situation is an unprecedented situation. Yes? This kind of, there is no previous scenario or situation to compare this to. But at this moment in time, not even the British themselves know what is going to happen. Yes? So general uncertainty is not going to give any kind of strength to the British pound at this moment in time. So maybe it was taking a delay to break down while they were waiting for that Brexit vote to see what's going to happen. If that has been postponed, maybe adding to Theresa May's, giving more confidence that whatever she was trying to get accepted has less chances of getting accepted. And maybe that is also what has pushed the sterling pound to get weaker today, make new lows as we see. And as opposed to the other majors, which are still holding, Euro USD ain't going down, AUD USD, NZD USD holding steady. We compare those to what is looking at sterling. It's clear to see that sterling is much, much weaker than all the other majors we've seen on the board at this moment in time. Yes? Can I buy, okay, here's a good question, a funny one. Can I buy Forex to hold on for long? Maybe a week. Well, a week wouldn't really be long term, yes? So yes, you can buy and hold for a week. The only difference in cost may also be an added cost on swap, but not necessarily would be added as a cost. So the only extra cost for adding overnight and overnight and overnight would be the swap. But of course, we can buy on the longer term. And when I speak about longer term, I'm not only referring to a week, so much, much longer than that. Yes, consider this. There's some people who have been short in sterling ever since there. One trade. Yes, they're still holding. Is it possible to know a breakout that would be safe to take without a retest? These things we'll speak more about the is in this game. Yes. So try to think of the market in terms of probabilities. Of course, it's what I'm going to try and talk about tomorrow when we're speaking about technical analyst approach, of the approach of following rather than predicting. Yes. So following the market, i.e. letting it tell us what it wants to do, follow it rather than try and predict what it's going to do next. So we'll discuss more about that tomorrow. All right, everyone. So that brings us to the end of today's session. So I hope everyone enjoyed that. We will be back tomorrow, of course, to discuss the technical analyst approach and start building our first framework of technical analysis. Yes. So if you're not familiar with technical analysis, tomorrow also a very important day to join up. All right, everyone. So thank you very much for joining into today's webinars, and hope to see you guys again tomorrow for a continuation with the technical analyst approach. So have a good rest of the trading day. Have a good week ahead of you, everyone. Yes, remember that economic calendar. Of course, you will be getting the webinar notes in 24 hours time. You should be receiving them in your email to go over them again. All right, everyone. So thank you very much about that. And hope to see you again tomorrow. All right. Bye-bye, everyone. Ciao, ciao.